Well, hello, everybody. Thank you for joining me. And on behalf of my home country, Japan, I would like to thank all of you for visiting. So I'm here to share why you should be excited about the Japanese stock market this year. And at Nikko AM, we expect 2025 to be a good year for the equity market. I will begin by talking about the structural changes we are seeing in Japan, and then share where we see investment opportunities. And then I'll finish off with a brief introduction to our funds. Okay, so first, for those of you who are not familiar with us, Nikko Asset Management was established in 1959. And we are now one of Asia's largest asset managers. And as you can see in the chart on the left, more than half of our assets under management is in Japanese equities. So we have a large team dedicated to this asset class. We have 15 portfolio managers, and we have 14 sector analysts. All of them are based in Japan, and they're dedicated to delivering returns to our clients. Now, just as a side note, we are no stranger to Singapore. We have offices in money centers around the world, but our Singapore office is our largest outside of Tokyo. We've been here since 1988. Okay, then let's move on to why we expect the Japanese stock market to do well this year. Okay, so the first structural change we're seeing in the economy is an increase in wages. This was a theme last year, and it's still a valid theme this year. The darker green line you see here is the percentage increase versus last year in the base salary for Japanese workers. And you can see that it has been rising in recent years. Now, one reason for this, actually, it hit 2.7% in November. Okay, so one reason for this is the light green line. Now, this is the percentage of people who responded to a survey saying that, yeah, they're interested in looking for other opportunities at other companies. And as you can see, this too has been rising. Very similar to the wage growth line, actually. Okay, so let me explain this. In Singapore, it's quite common for people to resign from their current companies and look for opportunities at other companies. And because of this, companies often try to incentivize workers to stay through annual salary increases. This is actually not as common in Japan. So in corporate Japan, many people are employed under this system called shushin koyo. Now, this translates to lifetime employment. And it's literally for life. So my father worked for the same company for 40 years after graduating university. Many people join a company after leaving school, and they work there until they retire. Even after retirement, this is the case for a lot of the large companies. The companies have a pension fund. So part of your pension income comes from the company you used to work for. This is still the norm, but is slowly changing. More and more people are getting used to the idea of looking outside for opportunities. Also, the unemployment rate is low at 2.5%. So companies have to revise their salary plans in order to retain or attract new talent. Even at companies where all the employees are satisfied, these companies still have to raise wages, or else, of course, you're going to end up with unsatisfied employees. So to give you a few examples, there are many. So first, retailing. They own Uniqlo. They recently announced that they will be raising salaries up to 11% this year. And the company Suntory, now they distill the premium whiskey Hibiki. They announced, this was last year, but I think they raised wages on average 7%. So this is a very healthy structural change we are seeing in the job market in Japan, and this has been driving wage growth over the past 3 years. Now, this is important for stocks because wage growth sets off a virtuous cycle of price increases, which should lead to more corporate profits. Okay, so the second change we're seeing in Japan is improving shareholder returns as a result of stock market reform. In 2023, the Tokyo Stock Exchange asked listed companies to enact policies to improve valuations, profitability, and shareholder returns. Sounds good, right? Okay, so some specifics. Some companies have responded by raising dividends. Now, in this chart here, the darker green bars show the percentage increase in dividends from the previous year. So in 2023, on average, companies raised their dividend by 9%, followed by another 14% in 2024 to November. There's another aspect to improving shareholder returns, and that is share buybacks. Now, from time to time, companies buy back their own shares, and this supports the stock price. The light green line that you see here is share buybacks as a percentage of market capitalization, and you can see that this too has also been rising. One example would be Honda Motors. Many of you may drive their car. Last year at Christmas, they announced a large-scale stock buyback program, and the market wasn't doing too much during that week, but Honda's stock price rose 7%, outperforming the market by 5%. So it's like a little Christmas present for the Honda shareholders. Now, you may wonder, are dividend hikes or stock buybacks likely to continue? And at Nikko Asset Management, we think they will. And here's the reason why. The majority of companies have the financial resources to continue dividend hikes and share buybacks. On the right of this orange line, this is the number of companies that are net cash to their market cap. Now, net cash is simply a company has more cash on hand than the amount of debt that they have to repay to their creditors. And as you can see, a large portion, actually this is 61% if we exclude the financial companies. 61% of companies listed in Japan are net cash to their market capitalization. So yes, there is room for more dividend increases and share buybacks to continue. This is a phenomenon quite unique to Japan. For a long time, after the bubble burst in 1991, companies were reluctant to invest because there wasn't much economic growth. And since these companies were not investing, for example, in people or technology or research, they just simply accumulated cash for a rainy day. And now, as they comply with stock market reform and better governance, they are able to use this cash to increase shareholder returns. So up to here, we've discussed the high-level structural changes going on in Japan. Let's move on to where we see investment opportunities. So firstly, we think there are opportunities in the consumer or the retail sector. As mentioned earlier, Japanese workers are seeing an increase in salaries. And partly because of this, prices for a wide range of items are going up. And it's not just for essentials like groceries or medication or textbooks. It's also for non-discretionary items, such as household durable goods. This would be furniture or washing machines, for example. And I also want to add here that wages are expected to grow more than inflation this year. So people should see real wage growth. Another opportunity we are seeing is in the IT services industry. So IT services will be, like IT consulting, or when you get somebody to code a program for you. And the green bars here show total revenue in Japan's IT services for each year. And as you can see, this has been increasing in recent years. Very simple explanation for this. finally, companies, there's just more demand for IT services. Companies are finally investing in technology. They need to keep up with the times, they need to improve efficiencies, and it's also due to labor shortages. So I'm going to go out on a tangent here and address this labor shortage. And as many of you may know, Japan is facing a labor shortage due to aging society. There are just more people of retirement age leaving the workforce than there are people newly joining the workforce. And yes, this is a problem for Japan, and the government is addressing it. However, as you can see here with IT services, there are opportunities, and it is the job of our portfolio managers and analysts to go out there and look for these opportunities. So we've discussed wage hikes and price hikes, and these are inflationary. And so that is why the Bank of Japan hiked the policy rate last year for the first time in 17 years. They're expected to hike again this year, maybe even as early as later this month. And this is an opportunity for Japan's bank stocks. So just to chart it out, the lighter green line here, this is the 10-year Japanese government bond yield. And this has been increasing since 2023. Now, also rising almost in tandem with the yield is this dark green line, and I'm sure you've guessed what it is. It's Japanese banking stocks. I have two stock examples for you here. On the left, this is Sumitomo Mitsui Financial Group. They are Japan's second largest financial services company by market capitalization. Amongst other things, they have been improving shareholder returns by conducting share buybacks and increasing their dividend. And obviously, they are a beneficiary of Bank of Japan rate hikes. And on the right is Nintendo. Now, Nintendo is an example of a company that has evolved over time. And for a long time, Nintendo's stock price relied on the success of their gaming consoles like Nintendo Switch. And yes, their products are still innovative and still very popular. But with more and more people playing games on their phones and computers, people were starting to become skeptical about the future of this company. What they have been successful with these past few years is transforming themselves from just a game console company to a content-driven entertainment company. They took their best asset, which would be their beloved game characters like Mario over here, leveraged them to launch new business lines. They released a movie in Japan. They have merchandise, and they also started a theme park in Osaka. Okay, so fun fact, the company was established in 1889, but did you know the founder was originally a distributor of cement? Yes, cement, nothing to do with games. So he saw an opportunity in Japanese playing cards. Now, I wish I had one with you so I could show you, but for children to play with. But at the time, they were very popular with adults for gambling, like a poker game. And so he decided to make these Japanese playing cards. And that is how Nintendo got their start in the world of entertainment. Okay, so you may say to me, that's great, Kiku, but Japanese stocks are near historical highs. Is there any room for upside? And valuations suggest that there is. This chart here shows the average forward price earnings ratio for the Topics Index. This was 15 at the end of the year. And yes, it is slightly higher than the recent average of 13.7. But if you turn your attention towards the left of the slide, back to 2003 to 2007, the average back then was 17.3. And yes, it was higher. So the market has the potential for earnings. Valuations have the potential to improve from here as the market prices in an improving economic outlook. Now, 2003, 2007 is really relevant for today because Japan was going through growth at the time. Now, so up to here, I've spoken about why Japanese equities, wage hikes, price hikes, dividend hikes, and Bank of Japan rate hikes. From here, I will talk about why you should invest in Japanese equities with Nikko Asset Management. So one is that in Japan, there are many small to mid-cap stocks that are under-researched. You really need a team on the ground to dig up the best investment ideas. So what this chart is basically saying is that there is a wealth of information on the larger companies, but as the companies get smaller, there is very little, in fact, sometimes zero information or analysis out there. And the number of companies without much information is quite high. So as a whole, the market is under-researched. And this is a feature unique to Japan. You often see this phenomenon in emerging markets. But remember, Japan is a developed market. And it's rare to see a developed market with this many under-researched companies. So what does this mean for you? So since information on these companies is limited, even if a company has an amazing product, just because the company is not well known or well analyzed, the stock price is likely to be lower than what it actually should be, i.e. it's undervalued. And once word gets out there about this company and this product, the stock price is likely to rise. So you really need a team on the ground with the expertise and the contacts and grit to go out there and unearth these unhidden gems. Our experts at Nikko Asset Management are in a good position to do so. Our analysts and portfolio managers are local. There is no language or cultural barrier when they meet companies. And because of our track record, companies are willing to meet us. You might be surprised. A lot of companies are quite reluctant or selective about the investors that they meet. But we get those meetings. And the team covers about 1,000 stocks from large to mid to small caps, including some of these companies with very limited information. Our in-house local research capabilities are crucial to unlocking value in under-researched companies in Japan. So let me talk about what kind of funds are available on FSMOne. If you're looking for dividends, please take a look at the Nikko AM Japan Dividend Equity Fund. Today we spoke about how Japanese companies are raising dividends. This company invests in companies with high dividend yields, as well as companies that have room for capital appreciation because of expectations for higher dividends. The fund targets monthly distributions that are up to 5 to 7% per year. So again, if you're after dividends, may we suggest the Nikko AM Japan Dividend Equity Fund. And also available on FSMOne is the Nikko AM Japan Value Fund. This fund is based on our investment philosophy towards value investing. And in a nutshell, our portfolio managers seek to identify companies that are undervalued and likely to go transformation in the next few years. If you're looking to invest in these hidden gems, then the Nikko AM Japan Value Fund is for you. Okay, so this will be my last slide. So to summarize, wage hikes, price hikes, dividend hikes, Bank of Japan rate hikes are the key words for Japanese equities in 2025. Don't worry if you think you've missed the boat. Valuations are still relatively attractive, and we think there is room for upside. Now, why Nikko Asset Management? We have the experience and the track record. Our senior portfolio managers have 25 to 30 years of experience investing in this market. We have the research. Our funds are designed to capture key structural drivers. And our experts are based in Japan, so they live and breathe economic change in Japan and are in a good position to identify trends early. Okay, so this brings me to the end of my presentation. I hope it has been helpful. If you have any questions, our booth is right there, so please come visit us. Thank you for joining me today, and enjoy the rest of your day.